Thank you for joining us this afternoon for our webinar on proposed federal tax changes impact on health professionals. I can see that some of you signing in are GGFL clients, but some are not, so I'll start with a short introduction. My name is Donna. I am a tax partner at GGFL, and I'm joined by Kody Wilson, Manager of Tax. GGFL has been providing tax planning and accounting services to Ottawa businesses for over 70 years. Our clients range from various sectors. However, one of our main areas of expertise is in the medical and dental area, servicing over 700 medical and dental clients. Before we start the presentation, just a few small housekeeping items. This webinar is being recorded and will be available on our website afterwards. There is also a chat box on the right-hand panel of your screen. Please feel free to submit questions throughout the presentation. We have allocated some time at the end of the presentation to answer those questions. So by way of background, during the election, the Liberal government ran on a platform to cancel income splitting and eliminate other tax breaks and benefits for the wealthy 1% of Canadians. Since their election, we've already seen numerous changes made. The increase of the top federal rate for individuals earning over $200,000 by 4%, making the combined top federal and provincial rate for an Ontario resident to be 53.53%. They froze the small business tax rate at 10.5%. And more recently, in 2016, we saw the elimination of the family tax cut credit, as well as the universal child care benefit, replaced with a new Canada Child benefit. In the 2017 budget, they indicated they would address specific tax planning strategies for private corporations. And then over the summer, the federal government released its policy paper on July 18th, which included draft legislation of certain proposals. At that time, the federal government provided a 75-day consultation period for public comment before passing any legislation. The end of the 75-day timeframe will be coming up shortly on October 2nd. The policy paper identified three main areas of focus, which we'll talk about today. One, tax on split income, what is referred to as income sprinkling, and restrictions on the access of the capital gains exemption. Two, holding passive investments in a private corporation and how this will be taxed going forward. And three, surplus stripping, when income is converted into capital gains to get a preferred tax treatment. There has been much coverage of the proposed federal tax changes since its release. Editorials, articles and papers, radio interviews with those impacted, letters and email communications from organizations representing hundreds of thousands of independent businesses, professionals, and taxpayers across a wide range of sectors, just to name a few. But more notably is the attention that is being drawn on the physician community. So this webinar has been put together to discuss the proposed changes and more specifically address the impact to healthcare providers, the physicians and the dentists, and their professional corporations. The first item we're going to discuss is income sprinkling. Income sprinkling or income splitting is a common tax planning strategy where income is redirected from a high rate taxpayer to a lower income family member. By moving income to be taxed in the hands of the lower income family member, the total taxes paid can be reduced, having the effect of a permanent tax savings. A common plan for income splitting can be the repayment of salary to a lower income family member for work they provide to the corporation or to the practice. That family member owns shares of the corporation, though. Income splitting can also be accomplished by the payment of dividends on the shares held by those family member shareholders. This also has the added benefit of multiplying personal tax credits and the lifetime capital gains exemption that is available to each taxpayer. In 2001, legislation was passed allowing regulated professionals to incorporate. This legislation does not permit non-members of the profession to own shares in a professional corporation. However, in Ontario, the OMA negotiated with the government over certain policy issues, which resulted in the extension of the corporate share structure for family members to own non-voting shares. This meant that physicians and dentists were then able to include their family members as shareholders in their professional corporation. Those family member shareholders can be their spouse, their children, or their parents. In structures of a medicine or dentistry professional corporation, it is common for dividends to be paid on the shares owned by the physician or dentist, their spouse, their children who are 18 years and older, and even parents. For example, dividends to family members are used to pay down student debt more quickly, to help fund maternity leave or time off, to cover the cost of a child's university tuition and expenses, or to help aging parents in their retirement. The government believes this benefit of income splitting is not fair and that existing rules under the Income Tax Act dealing with income splitting are limited. Government believes that in order to benefit from income generated in the business, an individual should have to contribute to that business by way of a labor contribution or a capital contribution. This proposal is an extension of the current Kody tax rules. The government is also proposing to limit the availability of the capital gains exemption for family members, which I'll speak more on in the next few slides. So as a brief background, Kody tax was introduced in 1999, where payments were being made to minor children to take advantage of their low tax rates. So under Kody tax, dividends and certain non-arm's length sales of shares are subject to the top marginal tax rate if paid to minors. So the proposal now is broadening the scope of the sources of income that are captured under the Kody tax rules to include interest income, gains on disposition of property, and second generation income or reinvested income. The proposal is also introducing a reasonability test for items considered to be split income. If the amount is considered unreasonable, Kody tax will apply, essentially taxing that income at the top marginal rate. In addition, under the current Kody tax rules, Kody tax only applies to minors. However, under the new proposals, the reasonability test is looked at for two distinct age groups, for those 18 to 24 years of age and those over 24 years old. The test for the 18 to 24 age group is more strict in looking at the labor and capital contribution by the individual. For example, for labor, the individual must be engaged on a regular, continuous, and substantial basis in the activities of the business. So based on this, it appears that the individual would need to be employed on a full-time basis to meet the labor contribution test. Does this mean that an adult child in that age group who works for the corporation over summer months while they're off from school would not qualify? As for the capital contribution test, what would be considered a reasonable amount? The CRA prescribed rate of return that's currently at 1%. Currently, there's a lot of discussion amongst accountants and advisors on how contribution will be measured to quantify a reasonable amount, but there's no clear guidance which adds to the uncertainty of the impact of the proposals. For the 25 and over age group, the test is less stringent, but is still subject to the reasonability test in which labor and capital contribution by that shareholder is looked at. The draft legislation for this proposal on income sprinkling was released on July 18th, and the proposed rules will apply for 2018 and later taxation years. So what should we do now? We want to avoid any knee-jerk reactions. However, with these rules still in the proposal stage, careful consideration should be taken before any actions are made. One item to look at may be paying a larger dividend this year in 2017. Documentation will definitely be more important than ever to support contribution in case of review by CRA. Perhaps consider salary payment to family members who do work for the business, as salary is not subject to Kody tax. But keep in mind, any salaries or wages paid to family members must be at reasonable, fair market rates for the work performed. At this time, it's difficult to say what CRA's threshold for audit would be, or how CRA would even begin to administer the new rules and review dividend payments. The Kody tax rules have also been expanded to capture capital gains realized by family member shareholders. This affects the ability of the individual to access their lifetime capital gains exemption. These proposals will affect dentists and their family member shareholders. It won't have an impact on the majority of physicians, but only to certain physicians who may be able to sell their practice. The proposals also affect shares that are held by a family trust. As the current provisions on incorporation don't allow shares to be held by a family trust, there's limited impact there to a professional corporation. However, for any dentist who has set up a technical services company previously, and if the shares of that company is owned by a family trust, these proposals may have some implications to them. The lifetime capital gains exemption is available to each taxpayer and allows for $835,000 of proceeds on the sale of qualifying shares to be exempt from tax, essentially received tax-free. In the case of a dentistry professional corporation where family members are allowed to own shares, by issuing shares with value to them, On the future sale of the shares of that company, the capital gains exemption could then be multiplied by the number of shareholders. So under the new proposed rules, to be able to claim the lifetime capital gains exemption, the shareholder is now subject to more stringent tests. Minors or family trust shareholders would no longer be able to use the capital gains exemption. Adult family members, so the spouse, the adult children or parents, would be subject to the same reasonability tests as dividend payments that were previously discussed. There is planning that can be done to take advantage of the lifetime capital gains exemption. Capital gains can be realized in 2017 to use the exemption. There is also an election that can be made in 2018 to crystallize the shares, essentially bumping up the cost base of the shares to its accrued value in 2018 and using the capital gains exemption. However, careful planning around this one-time election is essential. Review and planning may need to start now to ensure that those shares qualify. It should also be noted that the election is not available to minors. The regular 24-month holding test is reduced to 12 months. The elected amount cannot exceed the fair market value. So for dental practices, a proper valuation report will be required for support. The election is due with the personal tax return for the year. Although a late election is allowed, there is a high penalty imposed for those that are late filed. Now I am going to turn it over to Kody to lead us through tax on passive investment in a corporation and surplus stripping.
Thanks, Donna. So I get the unique and distinct challenge of talking about this really unclear direction that finance is taking, which they perceive as an unfair advantage that's being received currently by incorporated professionals. And we'll specifically tailor this again to health professionals. So this is the one section, it's worth noting that there's no draft legislation to this point on passive investments in a company. For the first two sections Donna talked about, there is at this point. So it's more likely those two sections will stick versus the items they've discussed in this section thus far. So I want to leave a caveat out there that nothing is set in stone at this point. It's all very general and broad, and we'll have to wait and see what happens. But we know what they're generally looking to do with this section if it comes into play. So really what they're trying to do at a high level is match the investment base at the corporate level. So think the incorporated professional to the unincorporated employee. So there's no benefit or advantage to having investments in a company versus having them personally, okay? So what they're looking to do is have separate rules for corporate level capital, which is taxed at the active corporate rate, irrespective it's the low small business rate of 15% or the higher general rate of 26.5%. The rules will still apply. That's what they have the issue with, is you're paying lower tax in the corporation than you would have personally, which, as Donna mentioned, the highest rate is 53.53 right now. Okay, so going through it generally, what they're suggesting at this point, again, it's all just suggested at this point. They're looking for feedback from the legal, accounting, and business community to tell them what makes sense. Maybe it's nothing, maybe it's everything, maybe it's some in between. What they suggested in a general sense right now is the refundable tax that we get for corporations right now, regardless of corporation type, is going to be eliminated. And what they're saying is, instead of being a refundable piece that you prepay and get refunded on a dividend payment, they're going to eliminate that. So what that means is the corporate level tax ends up being significantly higher than it is now. We'll see an example in the next slide or two where we go over what the rate looks like on investment income now with these current proposed rules versus how it stands right now. So what they're looking to do again is, so they're going to change the refundable tax piece. They're also making the eventual tax rate on a dividend when you draw it from the company to be the same as it is right now. So you're paying higher corporate tax and you're not getting the benefit, any benefit personally. You're still paying the same rate of tax personally. So it ends up in a much higher tax bracket overall. They've also talked about capital dividend account. So essentially what happens now when you have an investment is you sell it and have a capital gain. Half that gain is taxable, half goes to your capital dividend pool. And the benefit of this pool is it comes out tax-free to any of the shareholders on record. So what they've said is, if you're generating CDA, this capital dividend, you're selling investments, generating capital gains, if it stems from low rate capital that you've just paid the 15 or 26.5% on the corporate rate, they're now saying they're going to eliminate that CDA. So you'll still generate a capital gain, 50% is taxable. The other 50% will just stay in the company and not be able to be extracted tax-free. So as you can see, it's another disadvantage of these new rules as proposed. The other piece on top of that is eligible dividend treatment. So right now, if you get a dividend from a public company, in most cases, it's eligible. And the reason it's worth mentioning is eligible dividends are taxed preferentially to ineligible dividends. And the general idea there being there's a higher corporate rate that the eligible dividends stemmed from, so you get a better personal tax rate on the dividend when it flows out to shareholders. What they're saying now is if you get an eligible dividend from public company you've invested in, when you flow to a shareholder, you can't pay it as an eligible dividend. You'll have to pay as an ineligible dividend. So essentially they're saying no matter what the source of the income is, you're going to pay the same higher rate of personal tax on a dividend, regardless of where it comes from. So another drawback of these new potential proposed rules. So looking even further than that, they're also saying any intercorporate dividends that happen, they're going to look to see if they can tax those now. And the way it works right now is dividends between corporations, in a lot of cases, we can make it happen tax-free if certain conditions in the Tax Act are met. Going forward, they want to eliminate that altogether. They don't like capital moving between corporations on a tax-free basis. So to eliminate that, they're going to implement a temporary tax. So again, it is temporary, it's going to be refunded eventually. But the issue is you'll take an immediate tax hit for any money moving from, in this case, let's say it's a dentist corporation moving over to a holding company. So right now there's ways we can do that tax-free for our clients. Going forward, they might limit the use of this mechanism given the rules as they are proposed right now. It would apply on a go-forward basis. So everything we're talking about here in terms of passive investments and passive capital, it's all on a go-forward basis and not retrospectively, okay? So it's important to keep in mind they're not going back. So we don't want to make any immediate reactions and immediate decisions right now until we have some clarity from finance where they're looking to go with this and how they're looking to actually do that, because it's a very, very general and broad right now. So it won't affect companies without passive capital, which quite obviously, should stand out. I just want to make it very clear that if you have an operating company and you're taking out all of your profits as dividends or salary and not retaining any money at the corporate level to invest in whatever it may be, stocks, bonds, mutual funds, these rules will have no impact on you from a passive income point of view. So further to all this stuff, they're also talking about some general methods for how a dividend to the shareholder gets treated based on the source of capital it comes from at the corporate level. And again, these two are very general suggestions, which they've said may or may not stick. You may see both, you may see neither. We may see something totally different from what they have here. So I don't want to spend too much time discussing those and delving into the details of them, because they could change significantly when these rules get finalized, and both could just totally sort of fall by the wayside. And if that's the case and they do fall off, we're not as concerned. If they come into play in some respect, we'll obviously advise our clients at that point in time what makes the most sense for our clients. So I just want to generally touch on and tell you there is two methods suggested, the apportionment and the elective. And all you really have to know at this point in time is both these methods are just attempting to treat the dividend to the shareholder in a less preferential way than they are right now. And both these methods involve significant tracking and significant compliance costs with the tax for the taxpayer, which seems a little counterintuitive to what the Liberals have suggested in previous budgets, that they want to minimize the burden and compliance costs for small business owners. So the passive income stuff we've talked about, what we really want to know is what it means going forward, right? So specifically for our medical community is our holdco operations, potentially technical services company, a trust if it exists. There's limitations going forward now, specifically for income splitting. Current passive capital, it'll be grandfathered. They haven't specifically identified what that means in terms of generating capital dividends before the drop dead date or after that date. They're still sort of toying with that idea, but they have told us if there's capital that's been generated, being taxed at low corporate rate, we're still getting preferential treatment on that. And the current rules as they stand, so refundable taxes, eligible dividend treatment, and those kinds of things, capital dividend addition, that'll all still exist as it stands now as well. A pure investment holding company is also okay, right? Because again, they're trying to get the idea across that they don't like where you're paying the low corporate tax rate and then investing those funds, because your pool to invest with is bigger than the individual who's an employee and loses more than half their income to tax dollars, the new rates from Liberals. So they're also saying they want to have a high dividend tax rate when the money comes out of the company. And the reason they're doing that is to really penalize you for having these investments at the corporate level and not taking it out personally and paying the high personal tax rate immediately. However, there may still be advantages to using this structure, because when we take a dividend in retirement, typically the taxpayer is in a lower tax bracket. So if right now they're in the highest tax bracket, we may not leave the income there at this point in time at the corporate level, but when we withdraw it in retirement, maybe we're in a tax bracket that's half as high as the bracket they're in now. There's still some planning opportunities around that, depending when the income is withdrawn. And we should also tell you that dividend rates, the gross up, the credit, the tax rate on them, all of that can change substantially from now until the point the medical professional does enter retirement later in life. So here's our example, just to give you a sense of what it looks like. We've talked generally about this new non-refundable tax that's coming into play versus the refundable tax. So essentially the rates themselves aren't changing. What's changing is the 50.17 of income tax, which is the rate you pay on your passive investment capital, investment income. That rate's staying the same. The big difference is the next line, the dividend refund. So when you ultimately pay a dividend to your shareholders, you get a refund of $30.67. Okay, so the net corporate tax rate right now on investment earnings is only $19.50 once we consider paying amounts to shareholders. That means of the $100 you have of investment income, you can pay a dividend of $80.50 to shareholders. Assuming the highest personal tax rate, we pay $36.49 personal tax, leaving us with $44.01 of after-tax cash from the $100 invested at the corporate level. Conversely, in the proposed rules, it looks similar to the dividend refund point, where we no longer get that refund, which is just telling us that that 50.17 is a permanent non-refundable tax that we're stuck paying to CRA. As a significant disadvantage now, because your dividend to shareholders is much smaller now than it was previously. Now only extracting $49.83. And once we pay personal tax, again, assuming the highest rate in Ontario, we're going to pay $22.59 of tax, leaving us with $27.24. So as you can see from the example, what they're suggesting essentially is a 73% tax on any income generated in the company that's passive in nature, compared to the after-tax cash of $44.01 now. So just very quickly and very generally, you can see there's a significant disadvantage going forward now, and that is the intention of finance based on the rules and the issues they seem to have with corporations privately run in Canada. So that covers us off that piece. But the next piece is surplus stripping. We're going to spend very, very little time here, and the reason we're doing that is because there's essentially no impact on the medical professional community for this realm. So I can generally tell you what they're looking at doing, but there'll be very little impact on medical professionals. So really what surplus stripping is involves a complex set of maneuvers where you can convert salary and dividends into capital gains. Obviously, the benefit to doing that is if it's converted into capital gain, you're paying significantly less tax than you would if it was a salary or dividend. We don't employ this type of planning for our medical clients, so changes to these rules won't have an impact going forward, which you commented on. And the new rules essentially just cast a wider net for Section 84.1 of the Act, which really is what the first point is talking about. The only sort of positive that comes out of all this stuff is they have looked at intergenerational transfers. There are prohibitive rules right now that limit the ability to use a capital gains exemption on the sale to family members, which maybe isn't that much of an issue for the medical community because it's probably pretty rare where we're selling the shares to someone in the family. It's more of a concern for our operating companies where we can actually sell to somebody else, possibly the family, pass down to the kids or somebody else involved in the chain. So we're looking at rules to facilitate a transfer to family if it's a genuine sale. So there'll be rules around that to confirm that it is in fact a genuine sale. It looks at the involvement of the business owner going forward, the compensation paid, those types of things. But again, all of this doesn't really apply to our medical professionals, so we don't want to talk too much about that section. And I'll pass it back to Donna, and I'll talk about some options for planning as we near the end of 2017.
Thanks, Kody. So what do we do now? I know a lot of clients feel that time is running out for this year. So to recap possible planning for 2017 that will be at the forefront of every discussion likely. One would be consider payment of a larger dividend in 2017, especially to children shareholders who are 18 years and older. We'd look at paying this larger dividend now, which can be used to fund the next several years of tuition costs. But we also need to balance this with the comfort level of paying a high dividend to a child. Also to consider our payment of salary for services provided to justify future dividend payments, and also a salary is not subject to kiddie tax, especially to those family members who are less active in the business. For those corporate structures whose shares are held by a family trust, we'll look at possibly distributing shares held by the trust to the individual beneficiaries. There will need to be careful consideration concerning the one-time election in 2018 to crystallize the shares and use the lifetime capital gains exemption. With respect to the proposal surrounding passive investments, we may consider realizing capital gains on investments and electing to pay the CDA balance in 2017. However, since the paper is very vague in this area and still subject to change, any decisions to trigger tax would need to be thoroughly considered, and planning should be done in consultation with your investment advisor as well. So now we have some time to look at the questions that we've received over the presentation and provide some answers to those.
Okay, so the first question I see here now, it's popped up for us, is there's a question about income splitting for a non-incorporated professional. So the question essentially says, is there an issue for non-incorporated people? Because the changes we're talking about specifically deal with private corporations. It's a great question. The rules they're talking about here from finance don't specifically address this. They're just looking at the incorporated professional. So they're not looking at these kinds of things. So what the individual is getting at here is, if you're not incorporated, there's income splitting opportunities for investment income, as well as paying a salary to family. It could be the spouse, it could be the kids, it could be somebody else involved in the business that's related. They're not talking about that specifically now, and they haven't said they're going to. They're just looking at the corporate level right now, because that seems to be their biggest issue, mainly given the super low corporate tax rate that's being paid. So to answer the question quite simply, there won't be any impact on non-incorporated professionals going forward, specifically based on these rules they've come out with as of July 18th. Okay, the next one I see coming through here, with respect to the proposed tax changes just discussed, does this mean I shouldn't have incorporated? Donna, do you want to address that one?
Sure. I'm sure this question has probably crossed many people's minds, especially those who have recently incorporated in the last couple of years. The proposed tax changes doesn't mean the setup of your company was all for naught. There's reasons why the current structure was put in place originally. The reasons would be different for each individual and also to their specific situation. Corporate structure may have been set up for income splitting purposes, where you and your family members have received the benefit over the last several years to fund family and personal expenses, pay down student debt, pay for the children's tuition costs. For a newly trained dentist who is purchasing a practice, perhaps the planning was set up to incorporate a professional corporation in order to structure the purchase of that practice or the shares from the retiring dentist. This corporate structure would still continue to be used even with the proposed changes. A corporate structure can still be beneficial for many more reasons: to provide creditor protection, or sometimes as part of estate planning. However, any current corporate structure or future corporate structure will now need to be reviewed for the involvement of family members in the practice. Also to consider is whether the practice is sellable in the future. If so, what would this value be? What would be the expected gain? Depending on the answers to this, perhaps the loss of the multiplication of the lifetime capital gains exemption will not have as much impact as first thought.
Okay, one more that's come through here. It deals with a retired professional who's no longer making income from professional practice, and they're asking how this affects their the funds in passive investments going forward. The simple answer is it won't really, because what they're looking at is specifically now income you generate going forward that's active in nature, where you're paying the roll rate of 15 or 26.5. That's the capital they want to tack and add some additional tax to. If we've already paid that tax and it's before this budget date, and you strictly have a passive company, which we'll call a holding company, the rules aren't going to apply to you. So your capital should be safe, and you should be subject still to the old rules. So you'd still get refundable tax, you'd still get your capital dividend account. So we think those companies are okay. I will say there's a bit of vagueness in the discussion paper from finance, but they have said that a general holding company going forward should be exempt from any new rules.
So we just got another question in. It says, I am a family physician and don't earn as much as a specialist. I was considering incorporation. Is there any advantage to me now? So for those who are considering incorporation, the proposed changes do restrict or eliminate the two primary benefits of incorporation under the old rules, income splitting and tax deferral. However, if you're a family physician and you're operating your own practice or clinic, there can still be an advantage to incorporating. The corporation will still allow for more working capital for you to put back into your practice, to purchase medical equipment, office furniture, computer systems, to do leasehold improvements. It would also provide a level of creditor protection. If your spouse is active in the practice, for example, your spouse may be a GP working alongside with you, or is a nurse seeing patients in the clinic, or manages the office, you may already meet some of the reasonability tests mentioned earlier. The decision to incorporate should be looked at on a case-by-case basis, just as it was before, and especially now, and also after October 2nd, we should have more clarity on what changes will be made. I have an error question here. I incorporated several years ago. My spouse and my children, who are all adults, are also shareholders of the corporation. However, they do not do any work for me or the corporation. Should I wind up my corporation? Firstly, we don't want to make any rash decisions at this time, especially with the policy paper in the proposal stage. You likely had the benefit of paying dividends to your children and maybe your spouse as well over the years. There will be decisions that will need to be made this year, whether to pay out a larger dividend before the end of the year. However, this is going to reduce the retained earnings of the corporation. And as Kody mentioned, the government has said it will grandfather existing corporate investments. This means one of the initial benefits to save for retirement using the corporation is best achieved by leaving the retained earnings in the corporation before the new deferral rules apply. However, we're still waiting for more clarity on the legislation in this area and what changes will occur. So that being said, the level of passive investments that have been saved and retained in the corporation so far should be looked at before making any decision to dissolve the company. Okay, we don't have any more questions that have come in, so we'll wrap things up now. What I suggest is after the consultation time period passes and the government provides more clarity on what changes they are making into legislation, meet with your advisors to establish a plan for 2017 and also for the coming tax years. We'll be reaching out to all our clients to do the same. I would caution anyone who may be planning to implement changes in strategy now when the new rules are not yet finalized to be very, very careful. Thank you, everybody, for joining us today. We hope you found this session informative.